Alright, listen up, we're diving into the equity trade lifecycle. This is where the magic happens, or where the disasters strike if you're not careful. First up is trade initiation. This is the starting gun, folks. It's when an investor, maybe you, maybe a big fund, decides to buy or sell a stock. Think about it. You see a stock you like, say Mad Money favorite, Nvidia, you want in. Or maybe you think a stock has run its course and it's time to sell. That decision, that instruction, that's trade initiation. It's the very first, absolutely critical step. No initiation, no trade. Simple as that. This is your game plan taking its first breath. Now, when you initiate a trade, clarity is king. I can't stress this enough. You gotta be specific. What stock are we talking about? Apple, Tesla, how many shares? 10, 1,000? And at what price? Are you putting in a market order just taking whatever price is out there, or a limit order saying I won't pay more than this or I won't sell for less than that? These details are not suggestions, they are commands. Get them wrong, and you're playing with fire. Imagine wanting 100 shares and getting 1,000 before a bad earnings report. Ouch! Precision here saves you a boatload of pain later. Once that order is in, clear and precise, we blast off to trade execution. Your order doesn't just hang out in cyberspace. No, it goes to the market. Your broker, the trusty middleman, takes that order and works to get it filled. This is where the action heats up. We're talking exchanges like the New York Stock Exchange or the NASDAQ. This is the arena where buyers meet sellers. Millions of orders are flying around. Speed can be your friend here. You want the best price. And in a fast-moving market, that means your broker needs to be quick on the draw, finding someone on the other side of your brilliant trade idea. And let's talk about that execution. It's not just about getting it done, it's about getting it done right. We're aiming for best execution. That means your broker should be working to get you the most favorable price possible under the prevailing market conditions. It's not just about speed, it's about price improvement, minimizing slippage. Accuracy is also paramount. Did the executed trade perfectly match your carefully crafted order? No weird surprises, like a different quantity or a price way off your limit. This is where good brokers earn their keep, navigating the wild seas of the market for you. Booyah! Okay, the trade's been executed. High fives all around. Not so fast, my friends. Now comes a crucial step: trade validation. Think of this as the quality control checkpoint. After your broker says, done deal, the system needs to check the details. Does everything line up? Is this a legitimate trade, or did someone fat finger a zero? Are all the necessary pieces of information there? It's like a bouncer at the velvet rope, checking IDs, making sure only the good stuff gets through. This validation ensures the basic data of the trade is complete and makes sense before it moves further down the pipeline. It's a non-negotiable step. The whole point of validation is to protect data integrity. You've heard me say it: garbage in, garbage out. Validation is the filter that stops bad data from polluting the entire system. It's looking for errors, inconsistencies, missing information, anything that smells fishy. If your trade ticket says you bought pear instead of Apple stock, validation should catch that. This step is a silent hero. It prevents much bigger, much costlier problems down the road, like a trade failing to settle. Clean data is happy data, and happy data means your money is working smarter, not harder. Get it right here, or pay the price later. Next up, after validation gives the thumbs up, is trade enrichment. Now, what in the name of Powell is that? It means we're adding more meat to the bones of the trade record. We take the basic trade details from execution and start layering in additional necessary information. This is info that wasn't there when you first screamed buy or sell. It could include things like specific settlement instructions, where does the money go, where do the shares end up, or maybe broker fees, regulatory reporting codes, or even tax information. It's about making that trade record complete and ready for all the downstream processes. Think of enrichment like this. Your initial order was the recipe, execution was baking the cake, and enrichment is adding all the frosting and decorations. Standard settlement instructions, or SSIs, are a huge part of this. These tell the system precisely which accounts at which custodians are involved, for both the cash and the securities. Tax lot information might be added if you're selling shares to calculate capital gains correctly. All this enrichment makes the trade settlement ready. It's about fleshing out that skeleton of a trade with every single detail needed for it to be processed smoothly by everyone involved, from your broker to the custodian to the clearinghouse. Alright, the trade is executed, validated, and enriched. We're getting closer to the finish line. Now comes trade confirmation. This is a big one, folks. It's where both sides of the trade, the buyer and the seller, or more commonly, their brokers, formally agree on the details. It's like a digital handshake, but it's legally binding. Confirmations are sent out, usually electronically, stating, yes, we agree. Party A sold X shares of Y stock to Party B at Z price on this date. This isn't just a friendly note, it's a crucial document that locks in the terms of the deal. Why is this confirmation step so darn necessary? Because it prevents misunderstandings and disputes later on. Imagine the chaos if there was no formal agreement. One side might remember the price differently, or the quantity, or even the stock. Confirmation nips those potential arguments in the bud. It provides a clear, unambiguous record of what was agreed. This is especially vital in fast-moving markets or for complex trades. It's a cornerstone of trust and transparency in the financial system. Without it, you'd have a Wall Street brawl every 5 minutes. This is serious business. Now let's talk about trade reconciliation. This sounds complicated, but the idea is simple. It's all about comparing records. My books say this, your books say that. Do they match? This happens both internally within a financial firm, making sure their own trading desk and back office records align, and externally between different firms, like between a broker and a custodian, or two brokers who traded with each other. It's like balancing your checkbook, but for multi-million-dollar transactions, and it happens constantly. We're hunting for any discrepancies, any breaks, any differences, no matter how small. And what happens when we find those discrepancies during reconciliation? That's where the real work begins, error detection and correction. If my record says 100 shares and yours says 1,000, we've got a problem, Houston. The reconciliation process flags these breaks. Then, it's all hands on deck to investigate. Was it a typo during data entry, a system glitch, a miscommunication? The goal is to find the root cause of the error and fix it pronto. Unreconciled trades are a massive risk, representing potential financial losses or regulatory headaches. This proactive error handling is what keeps the gears of Wall Street grinding smoothly. We've initiated, executed, validated, enriched, confirmed, and reconciled. What's left? The grand finale, the moment we've all been waiting for, trade settlement. This is it, folks. This is when the actual exchange of assets happens. The buyer coughs up the cash, and the seller delivers the securities. Ownership officially changes hands. All those preceding steps were leading up to this. It's the culmination of the entire trade life cycle. It's where the promise of the trade becomes a reality. This is where you actually get your shares or your money if you sold. It's the payoff. Now, you might hear about the T+2 settlement cycle. What does that mean? For most equity trades, like stocks, settlement happens 2 business days after the trade date. T is the trade date, so T+2 is trade date plus 2 days. If you buy a stock on Monday, the money typically leaves your account, and you officially become the owner of those shares on Wednesday. This 2-day window gives time for all those crucial steps we just talked about: confirmation, reconciliation, making sure everything is in order. This standardized time frame is key for market efficiency and predictability. It allows everyone to plan their cash flow and manage their positions. The importance of settlement cannot be overstated. It's the bedrock of the market. Without settlement, a trade is just an agreement, a piece of paper, a digital promise. It's not complete. Settlement finalizes the transaction, making it irrevocable. It significantly reduces risk for both the buyer and the seller. Imagine paying for shares and never receiving them, or selling shares and never getting your cash. Settlement, when it works correctly, ensures that these nightmares don't happen. It provides the certainty and finality that underpins investor confidence. This is serious, fundamental stuff. So what if, heaven forbid, settlement fails? It's not common, but it can happen. Maybe the seller doesn't actually have the shares they promised to deliver, a fail to deliver. Or perhaps the buyer doesn't have sufficient funds in their account, a fail to pay. This creates big problems, operational headaches, and potential costs for the parties involved and the market as a whole. The system has established procedures to handle settlement fails, including buy-ins or penalties, but the ultimate goal is always smooth, successful settlement on time. This is where the entire trade life cycle proves its worth, ensuring the markets function with integrity. Booyah! Mission accomplished!